Good afternoon. Welcome back to the public sessions of the Mediobanca Italian CEO Conference. Please switch off your phones and avoid standing up during this session because the session is being live streamed. We start with Andrea Orcel, CEO of UniCredit. He needs no presentation as usual, and it's his third time with us, so we thank him for his presence.
Thank you.
Thank you. Andrea, starting with strategy. You've been renewed for another 3-year term, and after 3 transformational years as CEO of UniCredit, what do you think this franchise is capable of, and how much of it we have not seen yet? Why does UniCredit remain an attractive investment case to you?
Well, I think what I'm struggling to convey is that I'm more excited I am today about what UniCredit can do in the next 3 to 5 years than I was at the time of UniCredit Unlocked. I think at UniCredit Unlocked, it was a leap of faith of what I thought the franchise could do. Now I know what the franchise can do. And in a way, we are all excited internally at facing a normalization of rates and a normalization of cost of risk, because as the tide will go down, the difference between true outperformance versus what everybody's getting will be more clear. The way I look at it is the following, maybe financially, although it all comes from a completely transformed organization. One, we have undisputed cost leadership at the moment, and we think that we can only enhance that lead, as I don't think many peers in the sector will be able to keep costs flat in the next 3 years. We will. 2, we have managed to structurally reduce our run rate of cost of risk to a level that is among the best in class, because at the end of the day, your asset quality is linked to that. And because of the overlays and extra provisions we have, we're pretty confident that we can keep it there. So when cost of risk normalizes, we think we're going to be hit a lot less because we will have the buffer to face that. 3, we also have leadership in capital in terms of organic capital generation because of our model. Many people talk about distribution, but distribution are linked to your model of business, and we can talk about that later, and revenue over RWAs. If these 3 things, we strongly believe are leadership point that we will keep through the next 3 to 5 years, given all the levers that we have. As I move on the top part of the P&L, on the top line, I think the question on fees, we think we have no question, because we've managed already to increase the fee portion to 33% about. We think that everything being equal is going to grow from there, and depending on how much NII compresses, it could go to as much as 40%. So that would put us in a position of real strength with respect to the fee component in our P&L. These are fees that are more diversified than everybody else because they're balanced between, and will be more balanced between, investment, insurance, payments, advisory and capital markets, and other stuff. The growth will be greater also because in addition to market growth like everybody else, we also have the impact on the investment we've made and on the internalization we need to make in asset management, in insurance, in payments. And therefore, that will add to the normal growth that we will get from the market reviving. Therefore, the whole battle, if you want to look at it that way, is played on NII. And I think on NII, we continue to take a view that may not be the more generalized view. And in our opinion, there is bad NII, there is good NII. What is good NII for us? For us, good NII, it's an NII that, corrected for the cost of risk through the cycle, exceeds the cost of equity. And we believe that only 2 banks in Europe have that, and we're one of them. And the other bank that has that has an incidence of fees that is about half ours. So if you combine the capital-light nature and the low risk of the fee component and where it's going to go, with the fact that our NII will clear the cost of equity adjusted for cost of risk through the cycle. We think that that will, together with the other three places of cost of risk, and capital efficiency, continue to give us leadership in return on tangible equity, in EPS growth, in DPS growth, in tangible book per share growth, in distributions, and let's call it in good net income growth, because I can generate a lot of net income growth, but that dilutes my return on tangible and reduces my distribution, but that's not the growth that I'm seeking. So I think when we talk a lot about growth, we need to also see, are we seeking growth above cost of equity that generate distribution and a model that is auto-supportive, or growth for growth, which is relatively easy in a bank to deploy volume, create NII, but that NII is done at a 2% return on equity if one wants to look at it that way. So for us, when we put all of this together, we feel very excited we'll deliver.
Thank you. And then I would say, to get the M&A question out of the way, because you know it's coming, we have had the profit growth phase that has come with the surge in distribution, and the share price has followed. Now the market is waiting to understand how you will deploy your M&A treasure. In principle, would you rather go for one all-in deal, or to continue having, spreading your chips on many different numbers to complete the distribution network?
Look, I think, obviously, two things. First of all, we look at it a little bit differently. We look at it on how much value can we create in the next 3 years, and how do we get there, and how do we increase that value. I think that our base case, given what I've said, will create additional value. So our base case sees a growth in net income over the next 3 years, and sees a return on tangible, in spite of Basel IV, that will remain above 15% and maybe significantly so. The defensiveness of all this, which then ties with M&A, is if everything goes badly, we will return to the market, that's our aim, half of our market cap. And that means we will return to the market as part of that 6.5 billion of excess capital. That is the base case, probably not the most exciting case, but it is a base case that sees us growing and returning capital, and like this, maintaining a safety net on whatever happens. What would be better is to deploy part or all of this excess capital in the right transactions. Mm-hmm. The right transaction, if I look at my ideal, are transactions that strengthen the group a little bit everywhere. Because in the ideal group, we would have greater contribution from Central and Eastern Europe. In the ideal group, we would consolidate in any of Italy, Germany, and Austria. And we would do that a little bit in a balanced fashion, not to become, again, overly dependent on one place or on another. So if you look at it that way, very few targets that, as you classified it, all in, do that. Usually all in gets you to tilt very heavily in one of the two main markets. And so we look at that with caution, because we think that we have a big advantage by being more spread. But you don't choose. So I would say we're ready. We know what is out there. We are very excited to see what will happen when rates go down and cost of risk goes up, and whether valuation that we feel are not there at the moment or do not justify us doing acquisitions will become more aligned to a level where acquisitions are justified, and then we will move. And if not, we'll give the capital back to shareholders.
Thank you. So moving to capital return then, you've been the pioneer of capital return and the market has followed you. Can we get more sophisticated and hear your thoughts about share buybacks above one-time tangible book, and if distribution can ever be too much?
Well, I think, well, let's put it this way. First of all, our capital return and in general our distribution and the mix of our distribution is not necessarily our choice, but it is the choice of what our investors require. And so when we look at that, the mix reflects the investors we have today, and we think we do a pretty good job at balancing the two. One thing that I always say is there is such a thing as excess cash distributions. And there is such a thing as excess cash distribution because, like it or not, once you have a dividend at one level, for you to, whatever reason, take it down, it's a statement. And therefore, it leads to a number of decisions that may not be the best in order not to attack it. Having a generous cash dividend, but not an excessive cash dividend, is probably where we're going to land at the end of a period. Share buybacks are more flexible, and they're more dependent on your capital generation, on your profitability of a year, and on everything else, and can be adjusted better. Then there is the whole discussion of do share buyback above the cost of equity, above tangible book value make sense or not? I think the issue is twofold. Number one, we owe it to our investors to give back the capital that we have if we can't employ it more profitably. So my saying, well, I can't do share buyback and I can't do this, cannot mean that then I cannot give back the $6.5 billion of excess to my investors. So ideally, I do a more balanced amount of share buyback and I buy something out, and that resolves the issue. But in case it doesn't, we will distribute out. I would also say that while it's clear that if you're buying below the tangible book value, there is no debate, above tangible book, it becomes a whole question of, do you strongly believe that you're undervalued vis-a-vis where you should trade, and therefore that delta justifies your share buyback, as opposed to blindly doing a share buyback just because. We think at this point in time that that is the case, so we don't have that issue. But that's how we look at it.
Thank you. And so linking to the usage of capital, there is a concern in some investors that European banks are not growing their balance sheet. So when do you think we will see banks returning to balance sheet growth, and how would this change sector valuation, in your view? How would you want to position UniCredit in this context?
Well, a few considerations on that. The first thing is, and I say that all the time, is till now, and I think it won't change, every year we distribute much less than we generate. So every year we distribute an amount that people feel is generous, but at the same time, if I take last year, we increase our CET1 by 100 basis points. That means we're not constraining growth, because if I was constraining growth, I would be right at the margin. So why aren't we deploying more? We're not deploying more at this point in time, not because we have distribution consideration, but because capital cannot be employed, in our opinion, at a level that covers cost. And therefore, we are, let's say, refraining from deploying a lot. So one element in terms of balance sheet growth that I think we miss when we discuss about growing a bank's balance sheet is, are you growing a bank's balance sheet in a way that, adjusted for cost of risk, it ensures, let's say, 3, 5, 7 years, depending on what you deploy, of return on equity from NII or from NII plus the fees on that client that is above your cost of equity? At the moment, difficult. Secondly, is their demand. And if you have economies in Europe that are growing below 1%, and with all the geopolitical uncertainty, the demand is not very much at the moment. Thirdly, there is where we are all going to land post-Basel IV, because every time there is an increase in capital density, there is a reassessment, at least at UniCredit, on each segment, and within each segment, each client, if we're clearing the cost of equity. So let's suppose it won't happen. But let's suppose that tomorrow we have an increase of 20% of density in a segment. It's very likely we're going to pull back because we don't clear the cost of equity anymore. So we're not these are not independent variables. These are all combined. If I look at the next 3 years, I think geopolitical uncertainty everywhere, not only in Europe, will continue. I think that volatility will continue. So do we all get more comfortable with volatility and geopolitical uncertainty and investments in corporates, the buying of homes for family, the spending of consumer doesn't care anymore and therefore expands? Therefore, you will see positive bank balance sheet growth. If we don't get that, then you're chasing a fixed amount, and what you're doing is you're dropping your condition and you're deploying below the cost of equity. We will not do that. And therefore, in our case, the answer will be no. So I think it very much depends on the environment and on whether each banks are focusing on, I need to grow my balance sheet, or I need to grow my balance sheet and still exceed my cost of equity and create a model that perpetuates. If the question is the second one, very few banks will grow the balance sheet if the conditions don't change. If the answer is the first one, because people look blindly only at the volume side of the equation, then some banks may grow and some others may not.
I was curious about one of your comments on Basel IV. We've gone from big fear a few years ago of what it could do to capital ratios and so on, to the market pretty much shrugging it as a non-event. What do you think?
No, I think, well, as you know, Basel IV for us is not immaterial. And I would say that part of the efficiency on capital use that you have seen in the last 12 months and the ones that you're seeing between now and the end of the year is an anticipation of what we need to do to absorb as much of the impact that we're going to get. But ultimately, you know, the point is that all banks are pretty well capitalized. And depending on the bank, the impact is not changing the story at all. I do think that what is more of a question, which at the moment I have a positive answer on, is beside the big event of Basel IV, below the line, are we increasing, our regulator increasing density within models, within you know, risks, and within, because if you're doing that regardless of Basel IV, and you've heard a number of issues around that, then it will continue creeping. That is the key question. For the time being, it's not the case. But after Basel IV is over, does that stop? And from there, we go in an environment that is stable, or it doesn't? For the time being, I would say it stops, but nobody's certain. I mean, it will be a big change for Europe, but we arrive at a final destination.
And so the bull case is that we go to a steady state on regulation and we can just forget about it, and we're there.
Yes.
After 15 years of re-regulation and mounting capital requirements.
And I would say that the bear case is certainly nothing close to what we have seen in the last 15 years.
Exactly.
So it's a much slower creep than what we have seen before. So it may, at the margin, affect the capital generation, but I don't think it will transform it.
And so basically, from your interaction with supervisors and regulators, you think that essentially the market is thinking we have reached a sort of steady state or more stability. Do you agree with that?
I would say yes, except some specific events. I mean, you've seen regulators saying, if people do not take this seriously, we will put add-ons. If people don't do that, we will put add-ons. So if you don't take those things seriously, then no.
Okay.
But I think if you say, I would have thought that every competitor or every peer will take these things seriously, then it's very close to steady state for how we're looking at it now.
Thank you. Just very directly, do you have any comments on Q2?
Steady as she goes. We've given you enough detail for the year, and we confirm that detail.
And what would you say to investors who missed the UniCredit train so far?
Well, I think, as I said, it's, you know, maybe I would say the following, that if you come in 21 or end of 21, beginning of 21, it is a clear restructuring story. High risk, high return. We got it right. We provided the high return. and we delivered what we delivered in the last 3 years. If you look at what started, at least for us in management at the end of 23, is another 3 years. The frame has changed. It's more, I would call it in equities term, moving from a restructuring to a blue chip, i.e. all of our indicators are at the top of the sector, and therefore the risks are notably less. And the returns, you can't think that we're going to double and double and double every time. But I do think that the market has not moved to assess us this way. And therefore, if you look at every valuation indicator, from price to distribution to price earnings to earnings growth, et cetera, we lag very materially our peer group. So I would say that given the confidence we have in delivering what I think we will deliver in the next 3 years, which I would think is positively differentiated versus the average of a sector and the peer group, and this fact, I think it's still a very good point of entry.
Thank you. We agree. I have to ask you a question on digital.
Okay.
You structure your digital strategy with high-profile hires. What do you think is the potential to change the business model and how? And do you have any up-to-date views on the digital euro?
Well, I think in this industry and in many others, which are not really the technology industry, CEOs are asked to a very difficult question, because usually they arrive in a bank, they open the bonnet of technology, they don't like it, and then the question is, do you close it back and say, it's not going to blow, but it's doing their job, let me kick the can forward. It's a very difficult question, because whatever you do, the real impact, you're going to see it 5, 6, 7 years down the line, not 1, 2, 3. And in 1, 2, 3, however, you're going to spend. You're going to disrupt, you're going to upset, and you're going to have to drive the change. We have chosen the uncomfortable one of, we want to leave this bank stronger than before. And therefore, we are doing all the things that we need to be doing to make it better. That takes time. We've been, in a way, lucky, because for us, the rate cycle has allowed us to continue overspending in technology more than we were spending before, without really taking a toll on the P&L. And we will continue doing that. How do we feel about it? In a number of places, we've done significant progress. But remember always that we have, on the one hand, we have a great opportunity. Think about the scale and scope economies of bringing to very close common denominator 13 banks that are working on different models. It's massive. On the other hand, to get there takes time, and it's difficult. So if I look at what we have achieved in the last 3 years, I'm positive. If I look at how much you're seeing of that, obviously it's disappointing because you cannot see it, and I can tell you any story until you see it either on the cost line, or on the revenue line, or on client journeys, or on market share, it doesn't count. But I think it is something all banks need to do. The way I look at it is the best way to fight fintechs and new entrants is to get your cost-income ratio down to their level, because it reduces the opportunity of entry, and to bring the client experience up to their level. And to do that, you need technology. And I think some of the progress we've done on cost is linked to technology, not much, because a lot has to come. And I think that the client service side will start showing as we move on. And this will allow us to be able to be more nimble, more agile, and to prevent disruption from fintechs.
Digital euro?
I knew you were going to ask that. On this one, I tend to agree with you to a large extent. I think it will happen. So, it's a question of sovereignty for Europe. We cannot not have the digital euro. I think the question is how it will happen. That is the question. I think this is where the debate is being had, and I think the core of the debate is, are banks going to be the infrastructure and the framework for the digital euro like the cash euro? Or is it going to be something that, while flowing through banks, is parallel? And the impacts are different. And this is where the debate is. I think if they are fully integrated, i.e., dear customer, you can have cash, you can have digital. At the end of the day, by the way, for many people, it will just be what is behind a credit card. They won't even see it. Then it's seamless, and it will be very good for Europe and very good for banks as well. If it's parallel, we just need to think about the implication, and the business model may change quite significantly, which will bring more change to the sector. And I think we're preparing for that, and whichever is the scenario.
So I think in 10 years, I've never finished a session early.
Good.
We're 10 minutes early, which leaves a lot more questions to the audience.
Oh,
so let's just push it to them then.
Okay.
Q&A.
Thanks for taking my question. When my colleague Andrea, early in your interview, asked you about M&A, you mentioned many times the word ideally, in an ideal world, and so on. Now, we don't live in an ideal world. So, in a not ideal world, on what ideals you would never compromise when it comes to M&A or even organic growth?
Look, I think, let me do a parallel with another industry, which I have lived most of my career in, investment banks. When I started investment banking, you're talking a long time ago. You weren't in this business. The whole objective was to be number one in the league table no matter what. And people were losing tons of money. And the view was, if I am number one in the league table, no matter what, in debt, in all segments of debt, in equity, in M&A, etc., this is a good business. And when you looked at the returns, they were not there. Then over the years, you started moving, balancing, and saying, I have shareholders and I need to reward those shareholders as well. So we start from the standpoint that what we do, we need to balance three constituencies: shareholders, colleagues, and clients, okay? Forget for this one, colleagues and clients, shareholders. For me, growing fast organically or through M&A and destroying value, I don't think I'm doing my job. I don't. And by the way, it would be easy because I could say, I'll do this transaction, I'll take the hit, and then we start from there. It's a sunk cost. I think if you start going in that direction, it's all a sliding down. So no, we will not compromise on that. Now, numbers are numbers and they're judgment. But for us, it is, if I take a 5-year view, beyond that, really very difficult to do that, okay? Do I think that by doing that transaction or by launching the new initiative we have launched on consumer finance or on protection or on other things, do we think that all loaded in, with all the synergies that will come in, A, we're exceeding the cost of equity, and B, we're strengthening the franchise? If the answer to those two are no, then we shouldn't be doing it, because size by itself has never been an objective. So when we look at a lot of targets, just to convert it into what he wants to hear, and I look at, okay, I trade below 7 times. The target is trading around 9 times. Consensus thinks that we're going to perform in 25 and 26 in an identical fashion. I have a very strong conviction that there will be a big differentiation between people who have prepared for 25 and 26, people who are diversified, and people who have squeezed the lemon in 22 and 23 and 24. Squeeze the lemon is what? We could have had 1.2 billion of cost reduction in the last 3 years and not invest a penny. We've had 300 million of cost reduction in the last 3 years and invested 900 million. So now we have factories, now we have lines of defense, now we have extra provisions. And when I look at 25 and 26, I feel comfortable. People who have squeezed the lemon and didn't do that, they look at 25 and 26, rates go down, no alternative source of revenues, cost of risk goes up, you go up linearly, one-to-one, et cetera, et cetera. I strongly believe banks are different, and because they're complex animals, people don't see. So based on applying what we believe for us to targets, we think that what is today appears to be below 7 and above 8 becomes below 7 and above 9.5 or 10 times. Then you put a premium. I'll let you think. I think Mediobanca talks about the UBI playbook. That was 43% premium. Okay. There will be no way an acquirer can generate value at double their P multiple doing that transaction. And therefore, for us, it's like we would love to do it, but the numbers don't turn. So this is where we don't compromise. Then it's not, oh, plus minus 15%. This is so clear that we are very clear in doing. And organically, it's the same, but I think we have a further positive bias organically, because we have seen, if you look at, we had almost exited consumer finance. Today, we have 15% of new production in Italy. And our expected loss is much lower than the sector because we have new models, technology, et cetera, et cetera. When 3 years ago in protection, which is the Italian word for P&C, excluding CPI, we had zero production. Today, excluding CPI, we have 14% new production of the bank channel in Italy on protection. So these are things where we had to hire the people, train the people, create new models, review the processes, automate, create the technology. But now, that is delivering. And I think, but when you start, you're digging in money and you don't know if the outcome is. I do believe I keep on being very surprised positively, and it's great, by the ability to adapt and to change and to embrace new initiatives that the entire network, commercial, retail, or whatever has. And every new initiative we have looked at and said, this is a priority, it will deliver, let's put all of our blocks in a row to get it done, has delivered. And so, for the time being, we have the undoubted advantage that I don't need M&A to deliver the next 3 years. We believe we're going to outperform the peer group average in the next 3 years just by doing what we know how to do. So M&A is above and beyond. If you're in a point where you have reached your wall, which in my opinion, we're very far away from being, then you start saying, yes, but if I don't do anything, I become a bond. We're very far from there. So we will do M&A if it accelerates what we're doing. We will not do M&A otherwise.
Any other question?
You were very comprehensive.
We finished you very early.
Thank you very much. I'll
Thank
give
you
you back 2 minutes. Thank you.